All right, so that was the Reserve Bank of India governor. No change in rates as expected, but that change in stance has come in. Let me quickly toss it across to Lata Venkatesh from the Reserve Bank of India studio for her quick take.
Well, the first point is that the stance has changed, but it has changed with a slightly hawkish tweak. We cannot ignore the fact that we've gone to neutral, but we will remain unambiguously focused on aligning inflation to target. Now, he repeated it unambiguously, I mean, not just when he mentioned it first, in the subsequent outlook paragraph as well. The governor repeated the word unambiguously focused on aligning inflation to target. The other point he said, which sounded somewhat hawkish, was his reference to the fact that although we have reached the last mile, inflation falling, we should also not lose sight of the dangers, and that also was kind of emphasized a bit much in terms of weather-related shocks and global financial instability, some commodity prices going up. So my sense is that yes, it is neutral, but he has tried to introduce the fact that they retain their flexibility for December. A stance change does not mean a cut in December, and that maneuverability has been raised or increased by the Reserve Bank. A third factor which I would say counts as hawkish is that he did not reduce the growth forecast. He has obviously reduced it for Q2, where there are telltale signs of slowdown. From the earlier 7.2 is brought it to 7%, but he has raised Q3 to 7.4. So the overall average remains at 7.2. I think he clearly wants to give himself room that a stance change now does not mean that a cut follows. But for us, the yields have fallen to 6.75, even 6.74 briefly when the cut was announced. So let me with that straight away go to our guests. Kaushik, what would you make of this? Most importantly, does a cut follow in December?
Lata, as I mentioned in the preview, that they probably would go for greater flexibility by changing the stance, given that the global rate cycle have turned and there are a lot of uncertainties on growth going forward. I think this is a very good step, and this is a very good time to change the stance. And as you mentioned, governor is trying hard to kind of signal to the market this does not necessarily mean that the next policy is a rate cut. But as you said, they've kept the optionality open. If things change quite drastically over the next few months, then why not go for a rate cut in December rather than February? It doesn't make a difference. And also remember that monetary policy is forward-looking. You had the discussion on deposit and lending rates. The point is that if you cut today, it will take 2-3 quarters down the line for the real economy to have some positive impact. So it's not like you cut today and you see improvement immediately in the next month or so. So they have kept the optionality. What I liked is, if you heard it carefully, and Governor emphasized on that point, he said not just the current inflation or growth dynamic, but the expected growth and inflation dynamic going forward gives us the optionality to change the stance to neutral, which basically means that he's indicating to the market that we know inflation will be higher in October, December, but that's mostly because of the base effect. But if you look a little forward, you'll see that inflation is coming down closer to our 4% target, and therefore, that may help us to, continue talking about the easing stance. On inflation, you've seen that they've reduced the inflation forecast for January, March to 4.2 from 4.5.
No, Kaushik, in a word, therefore, are you expecting a cut?
Yes, we are definitely expecting, rate cut. I have a forecast of 25 basis points in December and another 50 basis points in the first half of 25. So the total cycle is about 75 basis points rate cut in 2025.
Okay. I'll come to you for the other comments in just a bit. Let me just get first reactions from the others. Mr. Ashwini Tewari of State Bank of India is with us, the country's biggest banker. Mr. Tewari, what did you take away? Do you think that a rate cut is in the offing? All your first thoughts.
So our house view continues to be the Q1, which is January to March of the next year, not immediately. But as has been just said, that there is the flexibility now the RBI has, so that they can continue to monitor, and with time they will cut. And as we know, most of the central banks, most importantly the Fed, has already cut rates by a significant amount. So I think the international situation also favors this. The domestic situation, growth continues to be good, inflation is coming under control. All the things are aligned. And as you rightly pointed out, Lata, the governor has tried very hard to actually kind of downstream the expectations a bit so that people should not start pricing it in. But first, January to March, that is where we think there will be a rate cut.
Okay, but that would mean some pressure on margins, you think, Mr. Tewari? It could come in December as well. We don't know. It looked to me that he's hedging his bets. But that would be immediately a strain on the margins, you would think?
So, yes, theoretically, when the rate cut happens, what happens typically is that the short-term rates, repo-linked loans and other similarly T-bill linked loans will immediately reprice, whereas the deposits will reprice with a lag. So initially, there will surely be a pressure on the margins. But I think we have been through these cycles. So ultimately, it evens out maybe over a 3 to 4 quarters period. So I guess, yes, initially there will be a pressure on margins if the rate cut happens.
Okay, have deposit rates peaked, sir? Or you think there is still room for it to rise?
So the last month, the gap between credit and deposit has come down quite significantly. Now it's about 150 basis points. So as long as that continues, there will continue to be a pressure on the resources and deposits being the most important. So I think the peaking of deposit rates, largely one would think that way. But I would still say if the credit growth continues strongly, then we will have to tune our deposits or fine tune them as and when required in certain buckets. So we cannot say that it has peaked.
Okay, that means another pressure. Rajiv, a similar question to you. As Mr. Tewari is pointing out, and that's the biggest voice there, saying that if credit growth picks up, there is a pressure to raise more deposits. At the same time, look at the yields. The 10-year has gone down to 6.74. Corporates will prefer to borrow from the market. We already see a gush of issuance, CP issuances. So do you think pressure on margins will already build up for the banking sector?
Well, the stance has improved, stance has changed, and I'm quite delighted that the stance has changed. I think
Rajiv, I think we've lost Rajiv's connection. We'll get back to him in just a minute. Let's get the economist's words as well. Upasna, good morning. Thanks for your patience. What have you taken away in terms of the next rate cut? Just key takeaways.
Yeah, Lata, like you said, I think the governor has clearly tried his best to maintain a fairly balanced to a marginally hawkish tone. Largely, I would say because they would want the markets not to front-run this information to right away get to conclusions of the next move being a cut. But having said that, I think he's also highlighted that the conditions or the preconditions for a monetary easing is still there. But it is data dependent. I think that is very, very clear from this outcome. We do expect that the December rate cut is still on the radar. But global conditions, how they fare and its implications on India, the domestic inflation, all of this is going to be important to watch out for. Also, I would like to highlight that RBI, of course, has retained their 7.2% GDP growth. We do see at least a 30 basis of a downside to their expectations. And by the time they are meeting in December, at least they will get early indications as to how the festive season has gone through. And they would understand that there are downside risks emanating for the 7.2% GDP growth as well for the full year. So they would have to account for all of that. And the chances for the December rate cut still remain.
Okay. So December rate cut is what, 50-50?
No, I would say a 60-40 for the time being. I would still say that I would assign 60% probability of a rate cut in December.
Okay. We are still waiting for Rajiv Anand to join us. But we also have Kanika, of the chief economist from Union Bank, with us. Kanika, Pasricha. Your key takeaways, Kanika, and what are the chances of a December cut? Is it 50-50, 60-40 as Upasna says?
So I would say 50-50, but before that, I would say even compliments to you, because after that fieback speech, when the governor first time talked about balance between growth and inflation is well poised, you had highlighted that there's a possibility of change in stance to neutral. We'll acknowledge it was a surprise for us, frankly. But December 50-50, we would want to watch out for three conditions on inflation, as the governor himself pointed out. A, food prices, how do they pan out? Though by Q4, completely agree with what Kaushik also said, relief likely, and which is why they have kept it lower at 4.2% from 4.3 earlier. Second, geopolitics, how it's panning out, because this has been one of the key concerns for governor himself, oil price trajectory. Last but not the least, what's the stance on China? Whether it's Trump trade impacting China and overall global inflation, or China's stimulus itself impacting metal prices, needs to be watched out for. There's only one more point that we'll watch out for very closely, and I aligned with what Upasna said. High frequency growth indicators are showing signs of slowdown, but the governor has chosen to keep overall growth numbers unchanged. So extent of downside to growth numbers, our forecast is 7%. So how much more does it fall below 7% will also be a key deciding factor, whether it will be December or Feb. For now, we are at February, and a close watch on that. Thanks.
Okay. That's a very fair summary, and I would think that any central banker will watch very closely for the November 5th results from the United States, because that can meaningfully change inflation and expected inflation, as both the governor and Kaushik Das pointed out. Rajiv, I think we have you on the line. My question to you is, will there be pressure on banks already? We have yields, 10-year yields falling to 6.74, although the spread between yields and CPs is still higher than what it used to be before the index inclusion, etc. There is still a downward pressure on CP yields as well, which means banks will have to lend cheaper than they would have otherwise, but deposit costs are not falling. So is pressure on margins already building up even without a rate cut?
That's really the concern. You're in an environment where the 10-year is at 675. On the margin, we are raising non-retail term deposits, one-year term deposits at 775. So despite the fact that the policy stance has changed, I think unless we are able to see these short-term rates come off and the yield curve begin to correct, I think there could be some pressure on margins for banks, although there is some leeway in terms of how you will manage the balance sheet, between, for example, the higher yielding unsecured, etc., versus other assets to manage NIMs on the margin. But the way the yield curve is currently shaped is certainly a matter of concern for banks.
Okay. Well, you have at least some relief about LCR, but I will come to that in just a minute. Let me get Shobhit Mehrotra for first comments on, what do you see, Shobhit, for the 10-year itself going forward, and for corporate CPs and CDs as well? Corporate bonds in particular, I mean, will that be getting cheaper in terms of yields?
Thank you, Lata. I think in terms of 10-year, I think a lot of move has already happened, pricing in a shallow rate cut cycle this time around. Favorable demand supply, all that is slowly getting priced in. My sense is if the second quarter GDP growth number disappoints on 30th November, then perhaps RBI could start the rate cut cycle in December itself. That would mean 10-year heading even lower, and with the news of getting included in FTSE Russell in September 25, and the possibility of getting on even more global indexes in the future, the broader trend on 10-year yield is definitely headed lower. On your second part, corporate bond supply, even though a lot of the supply is of a refinancing kind, the flows, at least in mutual fund industry, are muted. The demand from mutual funds is, therefore, to that extent, impacted and is not significant. But if corporate bond spreads have been widening, And my sense is these are kind of attractive levels for spreads on corporate bonds. I think as GSEC yields keep moving lower, corporate bonds will move in with a little bit of a lag, but broadly the spreads should sustain or maybe widen just a little. So from that point of view, corporate bonds will also do well, but as typically happens in each cycle, they typically move, in line with GSEC, but only with a little bit of a lag.
Sure. Shobhit, do hold on. We have some more information coming in from the monetary policy report in terms of outlook. And, I'll get the economists' reactions after this. For FY26, assuming a normal monsoon and no further, policy shocks and structural, their models estimate that inflation will average about 4.1% for FY26, with 4.3% in Q1, 3.7% in Q2, 4.2% in Q3 and 4.1% in Q4. So 4.1% is the kind of number that the Reserve Bank of India is looking at. And as far as growth is concerned, for FY26, according to the monetary policy report, assuming again a normal monsoon and no major shocks, real GDP growth for the year is seen at 7.1%, which is just 10 basis points lower than the 7.2% projected for FY25, with Q1 at 7.3%, Q2 at 7.2%, and Q3 and Q4 both at 7%. So that is the additional information we have at this point. The results of the voting are also out, where, unexpectedly, where a lot of, people on the street were expecting, perhaps it is Saugata Bhattacharya who will dissent on the rate action. It is actually Dr. Nagesh Kumar who had voted to reduce the policy rate by 25 basis points in this policy. All of the other members, including Saugata Bhattacharya, Ram Singh and the internal members, voted to maintain status quo on rates. With that, Kaushik, let me quickly come to you on the inflation number that we now have for FY26, 4.1% average. What do you make of it? And again, on GDP, 7.1%, with 7.2% this year.
So as I told Lata, and Governor Das stressed on it, and he emphasized that it is not just the current inflation numbers, but the expected inflation and growth numbers that are there, which makes it, easier for them to, change the stance to neutral. So what he was indicating, without knowing these numbers in detail, is that next year we are looking at inflation averaging close to the target of 4%. And even if you take longer term forecast of January, March 26, it's close to 4%. So RBI can, easily start easing rates. You don't start easing rates when inflation hits 4%, but if you see a runway to 4%, you can start in advance, just like the Fed has started easing. Even when inflation is actually higher than their target, it will take a year or so for them to hit the target. So similarly, RBI can start in December or February looking at the forward-looking inflation projection. So I think inflation projection, unless you have a shock or something, 4% next year is possible. Growth, I think we have a little lower forecast. This year we have 6.9 compared to RBI's 7.2. And then next year we have around 6.5%. Whereas RBI is around 7.1%. But remember, RBI and other policymakers believe that India's potential growth rate is somewhere around 7.5% to 8%. So compared to the potential growth rate, even if you take 7.5%, if India is growing at 7% or slightly below that, and inflation is closer to the target of 4%, it will make a lot of sense for RBI to start easing. And we are not talking about aggressive easing like in the past. We are just talking about 75 basis points. And if that happens and repo rate comes down to 5.75, it will still be a substantial, kind of spread differential with the, Fed funds rate, which is expected to fall around 200 basis points over 2025. So I think this opens up the room nicely for a discussion of, rate cuts. And I think it is needed, given that we are going to have aggressive fiscal consolidation going on into next year as well. And therefore, you need some support for growth from the monetary policy side in order to maintain growth closer to 7%.
Okay. Thanks for that, Kaushik, and thank you, Ritu, for putting out the very important information coming from the MPR. I just want to add a caveat. The MPR forecasts normally become serious only when they get included in the monetary policy statement. So, since there is a long time to be able to forecast the fourth quarter of FY26 takes some doing, especially inflation at a time of climate uncertainties. So while it is important to keep it on the radar that the RBI continues to expect 4.1%, which means a rate cut, putting its hand out that a rate cut is likely, is very much a sign from the MPR. Significance of the MPR increases only when it gets included into the monetary policy statement. Right now we have only the Q1 number, which has importantly been reduced. Last time they said Q1 of next year, first quarter, will be 4.4%. They've reduced it to 4.3. So that becomes important. The Reserve Bank's trajectory is that inflation is aligning to target. Now let me come to the what is not there in the policy. The very important LCR projection, LCR rules not getting finalized. I would like the two bankers' views on that. Mr. Tewari, is that a relief? If and when it is announced, do you think there will be greater pressure on getting more deposits and moving into buying more bonds?
Yeah, so Lata, clearly the LCR rules, while they have not been announced, but RBI has not said that they will not be implemented. So we wait for that to happen. There will be an impact if they are announced as they were published. If they are announced as is, then clearly there will be a pressure on banks to buy more government securities, both from maintaining the levels which, for example, a bank like us normally wants to keep some cushion over that 100%. And currently we are upwards of 120%. So for us to maintain that kind of level, we would need to buy significant government securities. And in that sense, there will be a less availability of some of these deposits for the lending purposes. So we have given our comments to RBI, and we hope that there will be some fine-tuning of those rules as well. And thereby the overall impact, while the banks will be more safer, but the lending also should not be impacted significantly. That's what our hope is.
Okay. Well, fair enough. I'm sure the Reserve Bank will be cognizant of that, as well as the provisioning for infrastructure loans, project finance loans. Again, that will impact lending. If the two come together, there can be an impact on lending. Rajiv, just the last word for you on LCR not coming. When it comes, I mean, it can't be postponed beyond like a quarter, I guess. Will that mean pressure on having to raise more FDs?
I think, I completely agree with what Mr. Tewari just mentioned, that it is inevitable that there will be more pressure for banks to buy G-Secs. There will be pressure, therefore, on, margins as a result of that. But I think there are, we've also given our, suggestions and recommendations to RBI, primarily being driven by the fact that the vulnerability of outflows from retail deposits increases because customers are becoming more and more digital and using mobile and internet banking applications. In a sense, a bit of a contradiction in terms, right? I mean, the country as a whole is pushing digital very aggressively, and there are adequate checks and balances, unlike in the case of SVB, for example, where the deposit base was homogeneous. Here, it is all banks have a very, very diverse retail base. And there are adequate checks and balances in terms of how much you can withdraw, through internet and mobile banking on a daily basis as well. And I'm sure that RBI will take a pragmatic approach to this, of managing systemic issues on the one hand, and managing the overall liquidity for banks on the other.
Okay, point taken. I just wanted to add that at the moment, the larger NBFCs are at an advantage because the government security yields have fallen. There is a slight, not commensurate, but slight fall even in the cost of CPs and bonds for the NBFC. So actually we are seeing a stock like Shriram Finance rise by about, 3%, if I'm not mistaken, 4%. So clearly they are at an advantage, but really we have to look at the entire NBFC spectrum, and the not so strong, the smaller NBFCs may perhaps be suffering some bit of investor skepticism because of the important red flags that the governor has raised. Over to you, Ritu, for this fairly divergent reaction that we may see from the NBFC sector.
Yeah, in fact, some of the comments coming in about, NBFCs chasing growth at any cost being counterproductive, that RBI has seen some outliers, not to generalize the industry, but that it is bilaterally engaging with more NBFCs. And if it does not see self-corrective actions, RBI will again not hesitate to take corrective action against these NBFCs. He's not named names, but, again, he's highlighted, including MFIs, housing finance companies. There are some companies that are charging usurious rates. All of that, he expects these comments are going to be taken on board and some corrective actions will be taken. If not, we will see some action against these NBFCs as well. So keep those comments in mind. If we still have the bankers with us, while, of course, the personal loan growth that we're seeing in the latest numbers, growth has come down. Whether the Reserve Bank of India still remains concerned, about this, fast growth in the unsecured segment, if that will impact, pose some concerns for the industry, we'll have to see. Okay, we do not have the bankers with us. But finally, Kaushik, to summarize, next action you've told us repeatedly, perhaps in December or later, what would you next watch out for with the forecasts that we have at hand? And what is the quantum of rate cuts? Because the street is not really expecting a, steep cycle, perhaps a 50, 60 basis point, total rate cut, if at all.
So we are expecting a total of 75 basis points rate cut in this cycle. Okay. So 650 coming down to 575. But the more important thing to watch out for will be the MPC minutes, which will come out with the three new members, what their views are, to get an idea. And obviously, going forward, the most important decision of US elections and, the Fed policy in that same week, that will set the tone for, what probably can happen going forward, not just in India, across the world. And then GDP growth numbers, high frequency growth number, how inflation is behaving, all this probably will set the ground whether December is the right time for RBI to cut or not. But I think the broad message is India is at a stage where we can discuss a little bit of monetary easing, given that the global cycle has changed. And whether it is December or February, we think that in 2025, rates will be 75 basis points lower. I mean, the policy rate from where we are today.
Kanika, what is your base case in terms of the total quantum of rate cuts and when it starts?
So, Ritu, our base case is Q4. And, taking cues from what you said, 4.1% for next year, so next 12 months, close to 4% inflation. If I make use of a theoretical abstract of real rates, 1.4 to 1.9%, taking the upper end of the corridor. So space, in our view, as of now, is for only shallow 50 basis points rate cut cycle. What I would want to watch out for, apart from inflation risk that even Kaushik pointed out, food prices, though by the last quarter of the year, they may cool down, but near term, how does it pan out? Geopolitical tensions, oil prices, and China-related effects from stimulus or Trump trade impact. That also will have implications for global inflation. But this time round, well, I think the governor has kept the growth forecast unchanged at 7.2. Growth risks will need to be more closely watched out for from monetary policy perspective, in my view. Thanks.
Oh yes, and that balance that the governor constantly alluded to. Shobhit, you have the final word. As expected, the shift in stance to neutral, and now for the next year's, CPI numbers looking at 4.1%, at least as per the MPR.
Yeah, I think one important aspect which I would want to look at would be RBI's actions in terms of liquidity. How much surplus is allowed to build in a changed stance environment. Remember, tomorrow we have a 25,000 crore buyback of government securities, so we will get an infusion of that. Then we would have to see how liquidity is being allowed to build up, where are the overnight rates settling at. And that would be taking forward the change of stance in terms of action. And that could also have impact on yields and the money market yields and overall yield curve. So I think not just the change of stance in terms of mere words, but also in terms of action by RBI by allowing liquidity to build up, overnight rate to come down, and then overall yield curve to shift lower.
Okay. Gentlemen and ladies, thank you very much indeed for parsing the monetary policy statement. We are definitely going to get more color from the press conference, which starts at 12 noon. And we will touch base with experts if there are any outlier statements. There are bound to be at this juncture from the governor. Thank you very much. I think one statement that we could not